Hey listeners, afraid I've got to apologise in advance for the quality of my audio on this week's episode. Bit of a technical failure at my end. We'll get it right next time.
Hi, this is Albert.
And this is Luke.
Today is Monday, the 28th of September.
And welcome to another episode of the Telescope Investing Podcast.
In today's episode, we're going to have a look at a specific company using a number of our investment lenses and see how it stacks up.
And this company is Datadog. Is Datadog a rising star worthy of our investment dollars? But before we get into Datadog, do you have a story of the week, Albert?
I do, Luke. I read last week that in an interview with Time magazine, the CEO of Google, Sundar Pichai, said that 62% of his employees want to return to the office part-time.
It doesn't surprise me. It's pretty tedious, stuck at home and missing out on the corporate gym. I'm not surprised people want to get back to the office.
Well, the surprising thing is that he said that Google will try to accommodate that even after COVID-19.
So what's his plan? They're going to reopen their offices in a more COVID-friendly manner?
He didn't say. He just said they're going to try to be more flexible and have a hybrid model, whatever that means.
Sundar's thinking, instead of an offsite where you might go to a hotel for a big meeting, maybe you use the office space for your on-site and your face-to-face, but your day-to-day work is done sat from your home office at home.
Well, I remember talking about this with you, Luke, about 2 years ago. And we noticed that the nature of work changing and the advent of this technology that allows remote working, we thought that having a mobile workforce and remote working was a megatrend. But I remember thinking that this was going to take years to play out. But with the coronavirus this year, it has really accelerated this trend.
It's driven the changes in society much faster than anybody expected. We're forced into this model of working, and now the way we operate socially has to catch up.
But I do wonder whether it's a reaction to coronavirus and things will just go back to the way they were before after a few years.
Maybe. I kind of hope that it would drive a greater level of trust between employers and employees when you recognise that actually work still gets done, even though you're not looking someone in the eye. I read an interesting snippet yesterday on Reddit about one of the world's worst companies, inverted commas, where the boss was using Zoom and he's forced all employees to be permanently on Zoom during the working day and sat in front of their computer.
Did they name that company?
I don't think they did. It doesn't sound like somewhere I'd want to work.
Was it Facebook?
Definitely not. There's a lot of things Zuck is accountable for, but I don't think that's one of them.
Okay. So what's your story of the week, Luke?
So my story of the week is a bit more of an internal facing one, just to do a bit of a plug for some of the work we've been doing on our own Telescope investing website. So we've just recruited the help of a branding agency and we've relaunched the look and feel of the site, and we've got a whole bunch of new content up there. And I'm particularly enjoying the series that you and I are co-writing, Albert, on how to get started with investing. Is investing right for you? You posted a great article last week on how do I build and structure my portfolio. And I've got some thoughts on a part 3 in this series about managing a portfolio.
Thank you, Luke. I'm looking forward to your next article.
Okay, great. Well, shall we get into our focus for this week, which is Datadog?
First of all, let's just say that at the time of recording, neither me or Luke own stock in Datadog, but it's been on my watch list for a while, and I've been waiting for a time to really look into the company in more detail.
Yeah, me too. I noticed it maybe 4 or 5 months ago among a suite of software as a service vendors. It's a really interesting space, and I've been looking for ways to get invested in this area. So Datadog's been on my list. I'm glad we had the chance to do a bit of a deeper dive over the last few days.
Yes, definitely.
So as part of our prep and research, we thought we'd use all the different investment lenses in our telescope that we discussed last week to analyze Datadog and understand the company in a bit more detail and inform our own investment decisions. So what does Datadog do?
Datadog provides tools to help companies monitor their network and the applications that they provide to their customers.
Yeah, and what is monitoring? I guess it's making sure that things are still running properly, performance is good, systems aren't about to fall over or they haven't just fallen over. Basically, customers are getting the service they need.
Some people call this the observability space of the digital transformation sector.
Yeah, no, that's not a term I'd really heard before I started doing the research recently. And Like, I used to be a tech guy and I used to run an infrastructure team for a bank. So we had a whole bunch of different monitoring tools. That was a long time ago. The world has moved on. Technology's improved in leaps and bounds. I guess it makes sense to have all of your monitoring in one place. It used to be a bit of a dream back in the early 2000s. And for what I'm reading, Datadog have got that proposition. Their view of observability brings together monitoring of systems, looking at log files, tracing of transactions into this holistic view in a single place where you can see what your entire system is doing.
I think what they've done is made this really easy for the companies to implement in their infrastructure. They provide real-time interactive dashboards that can be customized for each team's function, I guess.
Yeah, and when these teams have this joined up view, it really helps with investigation. It helps you proactively prevent problems sometimes, and also helps you figure out why things did go wrong so you can stop it happening again.
Yeah, so a bit of history. The company was founded in 2010, so it's a very new company, and they IPO'd last year in September. As of Friday, they are currently with a market cap of around $27 billion.
So $27 billion. So if we were to buy this for our portfolios, this would probably sit in the smaller to mid-range part of the portfolio. We've certainly got some giants that are 10 or 20 times that, but also a couple of tiddlers that are smaller.
Yes, I would put it in the mid-range myself.
So let's talk about why we think Datadog is really interesting and worth deeper investigation right now. And it's really the first of our lenses. Does the company have tailwinds that are driving its growth right now?
I see Datadog as sitting in the middle of a number of megatrends. The megatrend of cloud computing and digital transformation.
And as companies try to move their computing into the cloud, get it off premises, really have somebody else like Amazon or Google or Microsoft running the infrastructure for them, because there's not much of a competitive benefit these days in having your own infrastructure. So you digitally transform, you migrate your processing into the cloud, and as more and more companies do that right now, that's creating a bigger demand and a greater market for tools like Datadog.
The transition to the cloud has the tailwinds of remote working accelerated by the coronavirus pandemic.
Yeah, as IT departments decentralize and more people work from home than ever before, it's important for companies to stay on top of their cloud computing operations.
And these days, most applications really need to be up 24 hours a day for 7 days a week. And companies are constantly looking for operational efficiency to make their systems as efficient as possible.
I saw a quite interesting quote in the recent earnings call, and I'm just going to quote from the CEO of the company. He said, "We believe recent events will accelerate the migration to the cloud as the economy improves. We win because we offer a broader solution with end-to-end visibility from back-end infrastructure all the way through to the end-user experience, and now security as well. And we win because we offer a truly integrated platform for a single paid view into the IT stack." He's really talking about the acceleration of their market caused by coronavirus and the fact that they're offering a single solution that monitors everything.
Speaking of leadership, it's worth noting that the two co-founders have very technical backgrounds. The CEO, Olivier Pomel, and the CTO, Alexis Lecoq, they met in a previous company called Wireless Generation before they started Datadog, because they saw how collaboration between teams can really help identify problems and find the solution.
I think it's great when the leadership of the company has experienced the problem and then they've got their hands dirty and they've developed a solution, and then that's grown into a big multinational global tech corporation. That shows leadership really understand the problem. They're not just professional managers and leaders of the company. They actually understand what the customers need because they faced those problems themselves in the past.
Yeah, they have a deep understanding of the space.
And the other thing I know that's really great is they've still got a really significant ownership stake. I think they both own at least 6% of the company each.
Yeah, so looking at the Glassdoor ratings for the company, they've got a Glassdoor rating of 4.1, and the CEO has an approval rating of 93%, which is high, but not extremely high.
Yeah, that's a decent rating, but it's not a great rating. We've definitely seen higher numbers, but I think a bunch of stuff can play into that. I'll give an example. One of their competitors is MongoDB. MongoDB's CEO rating is 98%. That's a really big number. But I guess there are a lot of things that make employees approve or disapprove of their CEO. And really anything in the 90s is, I would say, just not cause for concern.
Before I did the research, Luke, I didn't really know much about this concept of observability. I had no idea how much this market is actually worth. The company itself estimated that its total market opportunity is around $35 billion.
And I think Gartner have forecast that this area will grow to $37 billion by 2023.
Right.
That's not a huge market, though. We'll talk in a moment about how much of the market that Datadog has, but that's a pretty small opportunity. If they can grow to generating those kind of revenues, they get a dominant share in the market. That's still only tens of billions of dollars a year, like maximum possible revenue. It does put a bit of a cap on their potential growth.
But this market is likely to grow as more companies move to the cloud.
Yeah, I agree. And maybe to focus on where Datadog are today, so their revenues are, I would say, the sort of mid $500 million. And so that gives them about 1 to 2% of the market. They've got some much bigger competitors that have got a much larger stake.
Speaking of competitors, the company itself in their S1 filing listed that their competitors are IBM, Microsoft, Amazon, Cisco, and Alphabet. But I don't really see it that way. I think their real competitors are some of these newer companies that have specialized in the observability space. Companies like Splunk, New Relic, Elastic, and Dynatrace, and a recent IPO called Sumo Logic.
Maybe they're being a bit optimistic, saying that they're competing with Microsoft and Google. Perhaps they're getting a little bit big for their boots. But I agree. Companies like Splunk and Dynatrace, they do the same type of thing. They're really the direct competition. So what do you think in your research? What sets Datadog apart from someone like Splunk?
They were the first company to offer what's called the 3 pillars of observability. The 3 pillars of observability are infrastructure monitoring, application performance monitoring, and logging. And Datadog was the first company to offer all 3 of these in a single tool.
Yeah, I used to be a Splunk shareholder. I closed my position much earlier this year, but really just because I'd taken the eye off the ball. I didn't feel like I really had a handle on what the company were doing in the more recent years. But I do remember Splunk were really focused mostly on log monitoring. And I guess that's just one small part of the overall puzzle as to why your system may not be working properly.
Datadog has been adding new functionality and new capabilities to their platform very quickly over the last 10 years they've been around. These days, they offer 9 products. They have included network performance monitoring, synthetics, which is testing systems using simulated user activity, real user monitoring, and more recently, security monitoring.
Yeah, they're really trying to build this into a complete solution.
And I think security monitoring is a very big piece. I think the hack of Garmin this year really highlighted the need for cloud security and security monitoring. There's a movement now within software development to really have separate teams work together more closely. Developers now really need to consider both the performance of the system as well as the security. So they need a way to allow different teams to see what other teams are doing. And Datadog gives them that ability.
And I wonder if this is part of how they get embedded into an organization. If one team in a company brings in a little bit of Datadog technology to understand their part, is that a way of organically growing?
I believe that's how it works, Luke. Most companies start small, and the way that the Datadog pricing model works is based on the number of hosts and on usage. So if you're a small company, your costs are going to be quite small. But as you grow, then Datadog revenues will grow with that.
And that's really the beauty of the whole software as a service industry. There are a whole bunch of companies on my watch list in this area. This is exactly why they're growing so fast. With a software as a service solution, you've got really minimal costs up front to introduce it, at least in a small way. And if one developer or one team starts using the stack and they're getting value from it, it can really quickly scale out within a company. When I used to be a tech guy working in banking many years ago, when we wanted to bring in a new piece of software, it would often be a 6 months to a year process to evaluate different vendors, get procurement involved, have a huge negotiation, plan out years worth of your rollout roadmap to try and agree pricing. A really big barrier to getting started. But in modern times, with things like software as a service, you don't need to do any of that. You can just, one guy can bring the thing in, get it working, prove it really in the organization. If it works, it grows organically by virtue of its success rather than do this huge corporate mobilization around a big decision.
And in their latest earnings report, the CEO said that 68% of their customers are using more than one product, which is up from 40% last year.
That's great, seeing that organic growth within their existing customer base. Might be worth talking a little bit about the financial side of that as well.
As you're implying, Luke, existing customers are paying Datadog more each year. And this can be measured with a metric called dollar-based net expansion rate, or DBNER for short. And for Datadog, this has been astounding. Their DBNER has been over 130% for the last 12 quarters.
And just to put that in plain English, that's every customer, if they spent $100 last year, this year they're spending $130. They're growing within their existing customer base. And there's really no clearer sign that existing customers are getting true value from the product because they're actively increasing their usage.
I think that is a very clear sign of the value they're adding to their customers.
Yeah, the customers are putting their money where the mouth is and they're just spending more with the vendor.
The company Datadog has received a number of awards. They were listed in Forbes Cloud 100. They were ranked in the top 10 fastest growing companies in North America in Deloitte's 2016 Fast 500 list. And they've received a number of other awards. These are all great, but customer behavior is more important. The fact that customers are spending more each year tells us a lot more about their reputation within the space.
Yeah, totally agree. Not to cast aspersions on some of these awards, but often you can buy an award as a company. I would always look at that with a little bit of skepticism. But let's talk about their customers, because customer growth has been pretty stellar.
Yes. As of the last quarter, they have 12,100 customers, which is up 40% from the same time last year. They have customers from all over the world and some of the biggest companies in North America.
Companies like Twitter, Mercado Libre, Zillow, Activision.
They have customers from all over the world, but only 24% of their revenue is actually coming out from outside North America. So they have a huge international opportunity, and they're really investing in this space to attract that business.
But if they've only got 1 to 2% of the market, they've got a huge domestic opportunity too. They're still a tiny player.
But I think having these international aspirations gives you a sense of the scale they're going for. They have recently opened offices in Paris and Tokyo to take advantage of this.
One thing I note in customers that's always really positive is they don't really have any deep customer concentration. If any one customer were to bail on them to a competitor, it's not going to hurt them too hard.
Yes, with 12,100 customers, I believe they have over 1,000 customers that are paying more than $100,000 a year.
That's a good sign.
Well, with 12,100 customers, Luke, do you think there's any network effects?
Yeah, I think a really interesting network effect is the way they use machine learning as part of their analysis. So they look at what's really happening in a system and they use ML techniques to identify when there's a possible problem occurring. Maybe there's a particular log file that's suddenly going crazy or some combination of factors that implies something's about to break. And they get this self-reinforcing behavior. The machine learning algorithms, the neural nets, train themselves on the masses of data that's happening, and that enables them to be more effective in the future. So the system kind of trains itself based on what's really happening.
I believe they call their machine learning layer Watchdog.
Snappy.
We've spoken a little bit about this earlier. I think one of Datadog's strengths is its optionality. As we said before, they've been increasing their product range very quickly over the last few years. And recently, they've acquired a company called Undefined Labs, which provides observability tools for developers, which may allow Datadog to extend their capabilities into the software development stage. Competitors in this space include Microsoft, Atlassian, and also a recent IPO called JFrog.
So I don't fully understand this, but I guess intuitively it makes sense. So they're monitoring what's happening in earlier environments like development and test. That enables the company to progress, build through the development lifecycle faster.
Yes, so it allows developers to consider things like security and performance more easily.
Okay, sounds powerful. Okay, so I think we've got a good sense of what the company are and why we think that they're in a really good space right now. We talked about strong tailwinds. We talked about the leadership and the brand and where their customers are, I guess we can't close this out there without taking a bit of a look at financials. Where are they at from a dollar perspective?
They expect the full year revenue for 2020 to be between $566 and $572 million, giving them an annual growth rate of about 56%.
That's great growth. And you covered it earlier, Albert, but their DBNR has been over 130% for the last 12 quarters. That's pretty consistent growth.
Surprisingly, they made a small profit in the first 2 quarters of 2020, and it gives them a PE ratio of 9,472.
So that sounds like a stupid number, but you just can't pay attention to profit with a company that's early in the growth cycle. They're plowing all of their money back into developing their product sets, R&D, growing themselves. So that might look like a crazy PE ratio, but just ignore it. It's a red herring.
Exactly, Luke. A better ratio to use is the price to sales ratio. And for Datadog, the price to sales is 49. This is actually really, really high, even for a high growth company. Just for comparison, the price to sales ratio for some of their competitors are around 12 for Splunk, 19 for Dynatrace, 18 for Elastic, and only 5 for New Relic.
Yeah, that really shows when you look at competitors in a single industry and you really want that price to sales ratio to be fairly consistent or within a certain band. For Datadog to be 10 times higher than some of their competitors, that's a bit of a big red flag. Maybe it's justifiable based on their better technology or their growth, but they really have to be a materially stronger company on a better growth trajectory to justify that kind of number.
Yes, a price to sales ratio of 49 assumes a very high rate of growth for many years. Competitors are not going to stand still. They can become much more competitive and really curtail Datadog's growth going forward.
It's a rich valuation. When we look at high growth companies in Telescope, we try and steer a little bit away from valuation. We try and focus on what the future's bringing and the potential of the company. But a price to sales ratio of 49 is still a big pill to swallow.
I'm not sure Datadog's growth really justifies a price to sales ratio of that high.
So I guess we're coming to the wrap up on our analysis, Albert. So maybe the key takeaway this week is, what are we both going to do? So what's your thoughts? We've done the research. Are you interested in adding some dog to your portfolio?
Well, I'm a dog person, so I do like the name Datadog, but that's not a reason enough to buy the stock. And it's also complicated by the fact that I own one of their competitors, Splunk, and that's been doing well for me, but their growth has gone down quite significantly over the last 1 or 2 years, mainly because of companies like Datadog improving their capabilities so much above what Splunk had originally offered. But Splunk, in the last year or so, has expanded their capabilities to include all 3 pillars of observability. So maybe Splunk now will start gaining back some of the market share. It has big clients as well. I think one of their clients is Shopify. Another one is Zoom, actually. They just recently acquired Zoom as a client. So I'm not sure, do I want to sell Splunk and buy Datadog? Or do I want to have a more of a basket approach where I hedge my bets across both companies? I haven't decided yet. How about you, Luke?
Yeah, interesting. I think having done the work, Datadog feels like a really good quality company, but it doesn't feel right for me. That's not to say it wouldn't be right for somebody else. I like the idea of investing in what you know, and although I used to be a real tech guy, that was a long time ago. I'm a dinosaur these days. And I just don't think I really understand their technology deeply enough to be passionate about them at the current valuation of 49 times sales.
But if you're looking for a high growth company with a long time frame, if you can wait a long time for this to play out, then maybe Datadog is suitable for a certain percentage of your portfolio.
I know you've already taken a position in Fastly, and I'm keen to buy myself some Fastly. They're another software as a service vendor. I think I get more clearly what they do, and I can see their growth much more clearly. I've not jumped in yet, but Fastly is probably higher up my watch list than Datadog is, having done the research.
Yes, Fastly is kind of similar in a sense that it's growing quickly, but they're still quite small. I think their market cap is around 10 billion, so they have a long runway. But they also have a lot of big competitors.
Yeah, maybe Fastly needs to be the subject of another deep dive in the future. So Albert and I use a number of sources when we're doing our research, but one website that's been really helpful in this space, and we want to give a specific call out to, Software Stack Investing at softwarestackinvesting.com. The material on SSI brings together a really deep technological understanding with a really good understanding of business. And I feel for companies like Fastly and Datadog and a number of their software as a service competitors, there's some really interesting insights coming from that source. I highly recommend it if you're looking at this space.
Yes, he only covers a handful of companies, but he really goes into really high detail. The analysis is amazing.
We've got a number of sources we use just like SSI, and we'll draw attention to them on future episodes. But it's good when you're investing in individual equities to do your own research, read around the topic, try and understand what's happening, try and solicit a broad range of opinions and views.
Well, before we go, we would like to say happy birthday to a good friend of ours from London, Taiji.
Happy birthday, Taj. Hey, Albert, aren't you and Taji the same age?
Well, that's all for this week. Thanks for listening.
If you enjoyed this episode of the Telescope Investing Podcast, you can find more content at our website, telescopeinvesting.com.
And perhaps also consider leaving us a review on your podcast platform of choice.
Thanks, Albert.
Thanks, Luke.
This podcast is for general information and is not a recommendation to act. Please seek independent investment advice before entering into any financial transaction. Entering into a transaction that involves securities or derivatives puts your capital at risk. Luke and Albert are not regulated by the Financial Conduct Authority or the Hong Kong Monetary Authority, and the companies mentioned in this podcast may be held personally by us. We can't be held responsible or liable for any action taken by a listener, and as ever, past performance is not a reliable indicator of future performance. Thanks and happy investing.